today. I hope you're having a good day. Look, today we're talking about balancing innovation with risk, and it's a timely session, as you all know, exploring that fine line between financial market innovators and building the products that markets love and also need, but also protecting against risks. And in some cases, this can be change for good, and in some cases, it can be for the bad with unintended consequences. So I'm really pleased today to have some esteemed panelists here to help us to share a bit more about what risk means and what is innovation in your respective companies. And but before we do that, I thought I'd let you introduce yourself. So I'll start with you, Julian. Teke, would you like to introduce yourself?
So my name is Julian. I'm the CEO and founder of WeFox, which is an insurtech from Europe. We're just in Europe now, but we're extending globally soon. And the secret sauce to our business is that we have not tried to eliminate the human agent in insurance, but actually provided the human agent with technology. So we're the fastest growing and now most valuable insurtech in the world.
Thank you. And then to your right is Shmuel Shafet, the founder and executive chairman of Target Global. Welcome, Shmuel.
So hi everyone. I'm Shmuel. I've been an investor and an entrepreneur since before the last crisis. I think that's how you say it today. And I manage Target Global, which is a pan-European investor based out of London, investing in technology from seed till pre-IPO around Europe, Israel, Middle East, Africa. And we are also proud shareholders in both of the fine gentlemen to my side, which is the most important thing.
And then to his right, we have Dmitry Tokarev. Thank you so much for joining us, from CEO of Copper.
Hi, Dmitry, CEO of Copper. We are the largest clearing and settlements service provider in crypto space. We're also one of the largest custodians in crypto space. Clients like Brevan Howard and State Street are our clients, and 80% of high-frequency trading firms. In a simple words, we basically protect client assets when they remain idle, but more importantly, with events from last week, when clients trade on venues connected to our clearing network, those assets don't go to exchanges. So we provide this middle layer of protection, which all of a sudden become very relevant from last week. Obviously, when the bull market was there and people buying NFTs, it was less of a conversation. So, but we can talk about the risk and things like that in crypto space. There is plenty of that.
Yeah, we're going to get into that a little bit more. But as the title of the panel suggests, I mean, risk is a very broad term and can mean many things to many people. But I want to start with Shmuel. I mean, with your company, what does risk mean to you when it comes to investing in the right companies, and how do you mitigate that risk?
So I think that as venture capitalists, we are, in a sense, risk managers. That's our main competency, is managing risk. And that's not only managing risk down towards the downside protection, it's also managing risk up towards the reward side. But in the end, our job is to balance a portfolio with the right risk-reward profile. So I think that's the main competency of a venture firm. I think that, and maybe we can get into it a little later, what we're seeing right now around the world and what we're seeing very much in the crypto market this last week, but generally around the tech world, is a bit of a 2008 moment for the venture industry, where an industry that was once very small, very boutique-y, very niche-y, has matured, has become systemically dangerous, and we're now starting to see that systemic danger come to pass. And I think the VC industry will have to understand its role as risk managers and have more compliance baked into the processes. I'm sure I'll leave Dima with the pleasure of talking about FTX, but I think one of the things that will be discussed a lot around that crash is what the venture investors didn't do around governance, around compliance, around really understanding the things that they were putting their capital and their name onto. So that's something I think will be a huge change from the venture industry today to the venture industry post this crisis.
Absolutely, and I do want to go into FTX because there's lots to talk about there. But Julian, in a way, you're underwriting that risk for a lot of companies, a lot of individuals. I mean, the biggest risk to all of us is climate change and the risk that has. I mean, how does companies like WeFox help with mitigating that risk?
Yeah, so risk is at the core of WeFox because we're a regulated company. And the way that we handle risk is that we really have a certain expertise where we understand and know the risk that we put on our balance sheet. And we have a very clear rule that everything we don't know and we don't understand, we would never ever put on our balance sheet. And in terms of our product portfolio, we have two different types of inventory. So we have third-party insurers, and that's more than 150 on our panel, and we have our own balance sheet. And only if we see that certain segments are very, very profitable, and we understand them very, very well, and we can forecast the loss ratios because we have the data about claims, only then we make the decision to put it on our balance sheet. We call that the cherry picking approach that allows us to grow very fast, so doubling business every single year. This year 600 million, up from 300 million last year, while really having risk under control on our own balance sheet.
Fantastic. And if only those users of FTX had insurance of some form. But can you tell me a little bit about how this changes the crypto landscape and what it means for the wider ecosystem?
Sure. Echoing what Shmuel said around 2008, pre-2008, there was a lot of collateral was mushed together, and people were producing instruments collateralized and collateralized over and over and over again. When crypto space started from retail. So the market structure in crypto is completely different from the market structure today in traditional finance. Market structure in crypto today that the exchange can act theoretically as custodian, clearing, non-clearing FCM, as an exchange itself. So everything is happening there. The reason why it stopped existing in financial services was actually a moment of 2008 where a lot of clearinghouses were introduced basically, whereas exchanges match the trades, then it passed for risk management to the clearinghouse. Clearinghouse then subsequently checks collateral with the non-clearing FCMs, and non-clearing FCMs subsequently custody those assets in a completely segregated way. So the mistake there, like it's really hard to basically do whatever you want with your client's money. It's really hard to also end up in a situation where you mismanage that collateral. So, and this is why we built this piece of infrastructure to allow essentially collaterals to sit in a regulated, insured custody account, which is fully segregated from all the client's money, where Copper cannot misappropriate or reuse or rehypothecate the funds in any shape or form. So, and that pushed a little bit, well, not a little bit actually, last week pushed a lot. I mean, for the last 8 days, we had highest number of clients onboarding, highest amount of assets coming in, and highest volumes coming through the clearing network. And I think this is just the beginning, because LPs now are going to apply much more pressure, not only on VCs in terms of like how do you do your checks and balances and how the corporate governance of the place looks like, etc. But equally, LPs in asset managers, which are hedge funds and trading firms, even if it's a prop capital, the due diligence is going to go a little bit beyond whether the person has been on a Fortune magazine, and because that standard was a little bit poor. So generally, it's the space obviously suffers from it, and we only see in the beginning of it. Don't get me wrong. There's going to be a third wave of all of that. There, we haven't seen it through yet. A lot of places going to go bankrupt. But then the infrastructural piece, the market infrastructure piece, is going to go 10 times in terms of stability where it is today, providing more sense to LPs and all the market participants.
And Shmuel, as an investor in fintechs like Copper, I mean, how important is regulation to you in that role in ensuring that the ecosystem is a fair playing field? So
I think that we have to all think about regulation. I mean, I think there has been a conversation around the fintech industry, around the tech industry in general. There's been a lot of ignorance of regulation. That's the truth. This wave, a lot of the companies that began this wave are companies like Uber or Airbnb, companies that went against the grain and basically said, we are going to do things that are really illegal, and regulation will sort of chase us and catch up. And I think that could be okay if you're doing ride hailing, if you're renting out homes. That has no systemic risk. It might bother the neighbors, it might bother taxi drivers. I don't think it's right, but it's manageable. But as this wave of innovation sort of went into the financial system and into things that are more complex, it's just unmanageable and unbearable. And I think we are at a point in time where regulators have to sort of up their game to understand what's going on in the fintech world. I think one of the biggest problems that Copper has is that regulators just are in most of the world. And I have to say that this is one of the only places in the world where speaking to regulators, they seem to do understand it and be of the sort of level of conversation that allows them to catch up. And that's one of the appeals of this region, at least I think a company like Copper. But regulators have to sort of catch up with understanding what's going on and have tools to deal with this constant innovation with the very, very complex concepts that, that companies like Copper and also WeFox offer. And for us as investors, I think we also have to start and really look into that piece of businesses, really understand it, really understand the regulatory risks, regulatory opportunities, and also be a part of the push for companies to get regulated. Because in the end, we are dealing with more than just our money, right? We're dealing in these cases with a lot of other people's money, a lot of the public's money. It's not only the big investors that stand to lose. And there, we can't afford to take the risk, and we shouldn't.
Absolutely. But, and Julian, I noticed that on your last round of funding, congratulations, you raised 400 million in your Series D led by Mubadala, and one of the largest fintech deals last quarter. So I wanted to talk a little bit about the new opportunities that this can bring you. You know, obviously in this region, health tech is growing, insurance is growing. Are there new markets and areas that you would like to expand into?
Yeah, I mean, so we think we have figured out kind of our model, how to internationalize the model in further European countries, but also then internationally. It's a really risk minimized model. So what we typically do is we would acquire a broker company in a new market, and then we would roll out our technology, increase their productivity, and then bring our own insurance products and launch them in the most profitable segments we see based on data. So we've done that several times now. In Switzerland, we started this strategy 3 years ago. It was a business with 15 million in revenues. 3 years later, it's 180 million in revenues. Last year, we acquired a company in Italy. It took them 100 years to get to 80 million in revenues. 18 months later, they will be ending this year at 200 million in revenues. So we have a proven model that we strongly believe does not only work in Europe, but also outside of Europe. And we see a lot of potential also in this region.
Fantastic. And I guess recently with the Abraham Accords, it means that the tech ecosystem between Israel and the UAE can grow even further. And Shmuel, I mean, having been based in Israel, how does that make you feel with the opportunities across that region?
So I have to divide it to my answer as an Israeli and as a tech investor. Those are two maybe slightly different answers. I mean, as an Israeli, obviously, I think it's an incredibly brave move, and what the leadership of the UAE did is something that will just a beginning of a wave that will positively impact every Israeli, I mean, positively impact the whole region. And as a sort of Israeli patriot, I feel that I'm also an Emirati patriot, and that's one of the reasons that I'm here. Because of it. As an investor, I think it's a unique opportunity to combine two platforms. So Israel is, apart from Silicon Valley, the only other complete ecosystem for tech, where you can find from healthcare and biotech and clean tech and software, you can find everything in a very small encapsulated environment at a very high level, but it's highly limited. It's highly limited by its workforce, it's highly limited by its small market, so it's outwards facing. And I think the UAE is emerging as one of the few global platforms, a place where a company can come, can build an R&D center, can attract talent from all over the world, can use it as a springboard east and west and to everywhere, and as a source of capital and many other things. And I think the combination of this relatively closed ecosystem and this very open ecosystem can do wonders. And it's 3 hours apart. It's culturally, I think, very similar and an easy transition culturally. And there's obviously a lot of goodwill on both sides. And I think it's really a unique opportunity for both sides of the equation.
And Dimitri, I mean, you're based in the UK, and you sort of across Europe as well. I just wanted to sort of see, what are your thoughts on the sort of differences that you see in the Middle East versus Europe, and what would you sort of say is your role in educating different markets?
Very good question. Generally speaking, I think crypto space have done a fantastic job in confusing people. Basically saying that this is very different from anything that we've seen, whereas it's really not, right? Derivatives are derivatives, whether they're basically done on bitcoins or on equities, they're still derivatives. So options, perpetual swaps, futures, and all of that. So the regulatory regime is already in existence today. So I think what UAE does very well is that there is an understanding that this is just another asset class and same rules apply. Whilst in Europe, regulators are drafting completely new regulatory framework, whereas I think an existing regulatory framework could be easily applied to this space in the same fashion it applies on anything else. Because in reality, the questions are still remain the same. What's your AML policy? What's your compliance culture? Can you evidence corporate governance? Can you evidence how risk management governance frameworks set up? Can you describe what the risks of the organizations are? Questions are still the same. If you trade underneath Shiba Inu, it doesn't really matter. So, and the crypto space have basically completely taken it like on a journey, like and DeFi and this, and then nodes and blockchain and multi-party computations and things like that, which is basically plowed a lot of paperwork on their table to go through. And this is, I would say, fundamental difference. I think it's also going to help on the next development stage, because essentially the infrastructure that we're creating in this space largely could be applied to traditional space as well. It's no secret, and everybody is of the same opinion, that we're going to see traditional markets moving on to blockchain. I think the world definitely now understands that the post-trade infrastructure for settlements is definitely coming onto blockchain, but the world has yet to understand, and different parts of the world are thinking about it differently. In here, it's actually far advanced, is that we're going to see superior financial markets products built on blockchain. So in the same fashion, like in '95, we basically looked at the internet that, oh yeah, it's just easier way to read the news and see the weather, but nobody could imagine that actually you're going to buy and sell everything under the sun through the internet. So you will basically migrate completely how you basically access liquidity and how you access financing. That's going to be done through smart contracts within 5-10 year time.
And if I may just jump in here, I have one great example, I think, how disruptive businesses can actually influence existing regulation. When we looked at the COVID vaccine and how it was possible to get a license within a year, before it took 12 years for a similar activity, how did they do it without cutting corners? The regulator had a 24/7 hotline for all vaccine producers to answer all of the questions, because typically what you do with a regulator is you would send a letter, they would basically wait 6 weeks until they answer, then they answer, you instantly answer again, and it's another 6 weeks backlog, right? So I went to my regulator and I said, listen, why don't we increase my regulator fee, and we put a designated team, because what I want is I want to be able to launch an insurance product a week, and not like the incumbents, every 6 to 12 months, right? I'm at a completely different pace. So please do increase my regulator's fee, but put a team there and let me call them whenever we need them to fix things fast, and we've done that. And we speed up the whole process. And I think that's regulatory innovation driven by disruptive players like us.
Yeah, and definitely, and you see that happening here in ADGM with the sandbox and things like that. I mean, what is that perfect environment? Is it just about timeliness, or is it about sort of getting together and having collaborative conversations? Are you interested in hearing from your other fellow insurtechs about their pain points?
I mean, I think we have a huge role to play. And that was the initial thing when we started filing for an insurance license, right? We were the first non-incumbent-backed startup that got an insurance license in Europe. And one of the horror scenarios I had while in this process, I was like, wow, imagine a world where we have implants in our bodies, and then the insurer figures out there's cancer cells developing and switches off the insurance. And the regulator asked me all these questions about financial solvency, and I have to fill out all of these forms, right? But there's not a single perspective on what happens to contextual data and how can we protect consumers' interests. And since we understand this technology, it is our role to go into a dialogue with the regulator and figure out solutions how to protect the consumer in the future. And that's what we're trying to do. We're trying to set up innovation circles with our regulator, and we try to brainstorm about how we can protect the consumer better together.
Absolutely. And you mentioned earlier that you use a network of agents and that's your distribution strategy. Do you see technology becoming more of an enabler as opposed to sort of replacing humans and using AI and such?
I mean, insurance is a product where you have to think about what happens to my family if I lose my job, or even worse, if I die. These are not things like you wake up on a Sunday morning and you want to think about it, right? So this empathy of a human when talking about these topics is an extremely important topic. And that's why 9 out of 10 insurance policies today are sold by the human. And that's why we believe the human will stay in the equation. We're betting on the human, and we're seeing significantly better customer satisfaction. We're seeing significantly better growth numbers, and we're seeing significantly better profitability. So I think we bet on the right horse.
Great. Well, look, it sounds like we're sort of needing to wrap up now, but if I could just quickly go through and just ask you each to sort of share one key message about your time here and what you sort of feel are some of the words of advice for some of our audience members. I'll start with you, Dimitri.
Actually, this will be a little bit to pile on the question that you guys discussed before.
Sure.
I think there is a massive opportunity right now which hasn't presented itself in the last 120 years. When it comes to capital markets based on blockchain, the requirement for a number of humans operating falls exponentially lower. So you will be able to run exchanges like NASDAQ with 300, 500 people. You will be able to run prime brokerages with 1,000 people. So, and that hasn't existed before. So I think the innovation piece and the opportunity for the region as well is that if there is innovation culture, which there is, when you work together with regulators to create those products, there is an opportunity to completely reshuffle how financial markets look like in the next 10 to 20 years. So that will be, I would guess, my closing thoughts.
Thank you.
So first, sell Shiba Inu. Sounds like an obvious one. But second, I think never waste a good crisis, right? This crisis is an amazing opportunity. It's not the end of crypto, I don't think. It might be the end of Shiba Inu. It's not the end of fintech or innovation, of venture investing. We are, I think, at the cusp of the greatest wave of value creation in the history of the tech industry. We're not at the end of it. We're just at the beginning. And this is an opportunity to do it right, to build things right, to build things on a solid foundation. And the smart investor, the smart founder, that's what they're going to do for the next 2 years. They're going to have a conversation with regulators, they're going to look inwards, and they're going to build things right. It's more important, and that's the lesson, by the way, of FTX, to build things right than to build things quickly. And I think that's one thing that our industry will have to adapt to in this new environment.
Julian?
So I think this region must be all about sustainable innovation for the future. And what we've seen in the last 10 years was that there were extremes. I think the time of these extremes must be over, and we need to look at really fundamental the fundamentals of the businesses and how substantial they are in really being able to beat the incumbents in a sustainable way. And they are out there. I think the extremes, they will be cleaned out. That's a healthy process. I'm happy about this process. But the sustainable and business with healthy fundamentals will continue to also support the sustainable future of this region.
Thank you so much. Well, with that positive note, thank you very much to my panelists here, and I hope you had a wonderful afternoon. Thank you.